Hello friends, I am Shilpa Wagh and in today's session we are going to talk about financial safety nets and insurance. In our journey of financial advancements, there are many hurdles which we face. There can be accident, there can be health related, there can be theft, there can be fire, and the worst is the life loss of the breadwinner of the family. So, how one protects the family from such hurdles in the financial journey? In various financial products, there is one category of financial product which helps us in such hurdles, and that is insurance. So, in today's session, we are going to talk about the various insurance products which can be helpful for a person to live a good financial life. So, what are the contents of today's session? We are going to talk about pure risk versus financial risks. There can be many types of risks, but which risks are actually covered by insurance? How to manage the risks? Okay. We will also talk about various types of insurance which are available, the key terms which are used in insurance, and lastly, while buying insurance products, what precautions or steps we have to follow. Let us understand the difference between the pure risk and the financial risk. We will talk about the financial risk first. Financial risks are those risks which either can give you gain or loss. For example, you invest in a stock. If the stock price goes up, you end up in profit. But if the stock price goes down, you end up in a loss. So, there is a probability of positive gain or negative loss, correct, in financial risk. It can happen in stock investment, it can happen in corporate fixed deposits, okay, because suppose you have taken a corporate fixed deposit, but the company from where you have taken the fixed deposit is BBB and it was not sustaining for the duration for which the FD was taken, and when the time comes when the FD has to get mature and you have to get money, that time you understand this company has gone bankrupt. So, you do not get the money. Okay. But if the company would have been good enough, you would have gained the money. Okay. Now, in such cases, you have to manage the financial risk with managing the proper diversification of your assets. So, put some assets in equity, put some assets in debt, put some asset in gold, put some asset in India, put some assets in outside India also. This is the diversification with which one handles financial risk. As against that, so what is the characteristic of a financial risk? There can be either a gain or a loss. Now, let us come to pure risk. Pure risk is the thing which has only loss and no gain. Like for example, theft, or you miss a flight, or you lose your baggage while traveling abroad. Now, in these cases, there is no gain whatsoever, there are only losses. Such risks are called pure risk. Okay. How are they managed? Depending on the severity and the frequency, these risks are managed with insurance. So, when you travel abroad, you must have heard people take travel insurance or baggage insurance. They also take internationally available health insurance, because these are the examples and the instances where the instance can happen and there is only pure risk, that means there is only loss. Okay. So, we have understood that pure risk can get insurance, financial risk cannot get insurance. That is the first learning that we have. These risks have to be classified onto two parameters. The first parameter is the impact and second parameter is the frequency. Okay. Now let us understand what is the meaning of impact and what is the meaning of frequency. The instance of a person getting a heart attack. Okay. Now the person is 30-year-old, a person is say 70-year-old, person A, person B. What is the chance or the probability or frequency of such profile person getting a heart attack? Obviously, low here, high here. Okay. Impact in both the cases can be severe. Okay. This is the example of frequency and the impact. Okay. So, the chances of it happening to a 30-year-old person is a low frequency but high impact, and a 70-year-old person is high probability and higher impact. Okay. So, any pure risk instance, or you can call it a risk incident, has to be classified into impact and frequency. So, we can have 4 different categories of such risks: high impact and high frequency, high impact but low frequency, low impact but high frequency, and low impact and low frequency. Okay. So, let us see how insurance, so out of these which one are eligible to get the insurance and which one are not is what we are going to see further. Let us begin with high impact and high frequency. Insurance companies will not cover these risks. Okay. We have to understand this. Insurance companies will give you, if the probability is very high of that instance happening, insurance companies will never get into that. Okay. Because they have to satisfy the claim. So, if a person is diabetic, we have given the example here, if the person is diabetic and obese, okay, if such a person goes to any health insurance company to take the cover, that person is normally denied the cover, because here the chances of hospitalization are very high and the frequency is also very high and the impact is also very high. So, in such cases, high frequency, high impact category, the person usually is not considered for any kind of life insurance or health insurance. Another example is, if one is into the adventure sports, the coach or the people who are actually getting into the skydiving or bungee jumping, okay, these are adventure sports, or they are always part of the Himalayan trek. Now, these are high impact zones. Okay, the challenge to the life, they are life threatening kind of a situation. The chances of these being covered by insurance companies are very, very less. Or there are locations which are near to, say, volcanic eruptions, okay, or there can be factories which are actually emitting very poisonous gases, and people who are situated near that or working in those factories. These are some of the instances where the problems can occur frequently and the impact will be high. Now, such risks will not be covered by the insurance companies. So, no insurance product will be available for such category of people. So, then how do they manage the risk? The only one strategy is risk reduction. Okay. They have to work towards, the person who is a diabetic and obese has to work towards situations, or he has to change his lifestyle in such a way that he does not get into the hospitalizations to the extent possible. Okay. People who are into the adventure sports, they have to manage their own finances in such a way that, because insurance company is not going to help them out. So, they have to see to it that they take proper care, they have good safety nets, okay, good safety equipment, so that the frequency of any such untoward incidents is managed and it is less. The next is high impact but low frequency. Okay, we are talking about now high impact but low frequency. Now, these are the correct candidates for insurance companies, okay, because the impact is high. So, the financial loss to the person might be high, but the good part is the frequency is less. So, a normal person who is say 30-year-old, he is working in a bank, okay, and he is staying in an area where there is not hazardous situations he has to face every day. He can be the right candidate for a life insurance company to insure him for the next 30 years. Okay. Asset loss due to theft or fire. Now, theft and fire does not happen every day. So, if one has to take the fire insurance, that is securing his property against fire, the company is ready to give, okay, because it is a high impact but less frequent event. Okay. Risk transfer is the strategy to handle high impact low frequency incidents. What is transfer? Who is transferring? Let us assume it this way, that if a house catches a fire, okay, it catches fire. The house contains all the goods, the total worth may be 80 lakhs. Okay, all expensive items and everything together in the household, the total cost is 80 lakhs. If the person has not taken any kind of insurance, this entire 80 lakhs burden has to be borne by the person. But what is he doing? He is taking fire insurance. In the fire insurance, he is declaring that I have property inside the house worth 80 lakhs. And every year he is paying money to the insurance company, which is called premium. To do what? If something happens and the fire is damaging his property, the company will bear the cost. Okay. So, if fire actually happens, now what he has done? The risk of taking the burden of 80 lakhs, he has transferred that to the insurance company. That is called risk transfer. Okay. So, the only types of risks which will be handled by insurance products are high impact and low frequency. Okay, we have to remember this. Then comes low impact but high frequency. Okay, this is our day-to-day activities. Catching cold and flu is what I am reporting here. Okay, or any day-to-day expenses while going. I misplaced my purse somewhere. Okay, these are low impact. It can happen. Okay, high frequency also, right? But there is no need for an insurance. Why? Because the impact is low. I can take the burden of that loss, right? What is the strategy to come out of this? Risk avoidance. Okay, so take care of your body, have a good lifestyle so that you don't fall ill again and again. Okay, what other things can be done? If you are carrying a purse, please take care of it properly. So, you try to get into the habits which will help you to avoid the risks. Okay, you will not go to insurance company for this. And lastly, low frequency, low impact. You are going to bear the risk if it happens. Why? Because the impact is less and the frequency is also less. So, in this case, even if first of all it is rare that it will happen, and even if it happens, it is going to give you less impact, okay, like losing a wallet, missing a train. Okay. Such things we will not get into the insurance. Okay. We will do the risk retention. I bear the loss. Risk retention is also called risk financing. Who is financing? You yourself. Okay, the risk is so low impact and low frequency that you don't mind taking the burden of that. So, you only finance that risk. So, you take the burden. That is called risk retention. So, we have seen 4 classifications of risks, okay, depending on the frequency: high frequency, low frequency, high impact, low impact. If it is high frequency and high impact, reduce the risk because no insurance company will have the stake in it. So, no insurance we are getting here. If it is low impact but high frequency, there is no need for any insurance company because the impact is low. Better avoid the risk, no insurance product again. If it is low frequency and low impact, again there is no need for any insurance. You retain the risk and finance the risk yourself. Burden is taken by you, no insurance required here as well. The only place where we want insurance is high impact and low frequency. Here we are transferring the risk to the insurance company because the impact is high. Okay. Once we have understood this, let us get into what are the different types of insurance which are possible. Very famously known is life insurance, then there are non-life insurance, and then there are health insurance. We will understand one by one what are these insurances are. Let us start with life insurance. As it is said, it is life insurance. So, the impact is what? Here, the impact is going to be on loss of financial gain due to death. This is very important. Due to death, okay, because of accident, because of mainly it is due to death. Okay. Now, what is happening in this case? The breadwinner of the family is no more. What happens to his family? His wife is not earning, his children are small. So, there is a big financial loss. So, impact is high, but the frequency is low. Okay. So, this incident is the correct candidate to get the insurance. So, here it is necessary for the breadwinner to take the insurance cover, life insurance. Okay. Very important, most important in this case will be term life insurance. Okay. Term life insurance is the only insurance which is pure insurance product. Okay. In this kind of term insurance, person pays premium to the insurance company and gets a cover on his life. Okay. The cover is called sum assured. What is the meaning of that? Let us take an example. A 30-year-old person, okay, he is going to work for the next 30 years of his life. Now, what is he doing? He is earning say 5 lakhs per year. Something happens to him and he is no more. What is the loss to the family? Financially, if you see, even if you don't consider that he is going to get the salary hike or anything, he would have worked for next 30 years and he would have earned 5 lakhs per year. So, that means he would have earned 150 lakhs for the next, that is 1 crore and 50 lakhs for the next 30 years. But if he dies at this age of 30, his family is going to take a loss of this 1.5 crores. And so, a term insurance will be taken by him, which will look something like this. He will tell the insurance company, I want a term insurance for sum assured of 1.5 crores for the term of 30 years. Okay, this is how he is going to tell the insurance company. So, insurance company will give him the life insurance cover. That means, if something happens to him for the next 30 years, his family will get 1.5 crores, okay, because of the insurance cover. This is called term life insurance, okay. And for this, he is going to pay some money to the insurance company, which is called premium, okay. So, he is going to pay some premium every year to the insurance company for the next 30 years. In return, the insurance company will assure him that don't worry, if something happens to you during these 30 years, we will pay 1.5 crores to your family. That is the meaning of term life insurance, which is a pure insurance product. Now, when I say pure insurance product, what is the meaning of it? Let us come to other insurance types and we will come to know about it. Except for the first, term insurance cover, all the rest, okay, they have two components. One is insurance, which is the basic assurance to the person who is taking the cover, and in addition to that, they also have a component of investments. Now, what is the meaning of this? Again, let us take example of the same person, okay. He is a 30-year-old person. He is going to continue to work for the next 30 years. That means his retirement will be at the age of 60, okay. So, he is going to work for next 30 years. What is he telling to the insurance company? Please give me a sum assured of 1.5 crores for the term of 30 years. Okay, fine. But his condition is, whatever premium I am paying to you, out of this premium, some amount you please keep to insure me, so that if something happens to me, my family should get that sum assured. But some part of it, you also have the investments done. So, let us assume that his premium is 60,000 rupees per year, okay. So, out of this 60,000, 30,000 is going to insurance and 30,000 is going towards investment. Because of this, if he survives the complete term of 30 years, he is going to get a lump sum amount as a result of this 30,000 being invested every year, okay. That is the format in which all these insurances will work, okay. What is whole life insurance? So, this is the format which is more or less followed by all these life insurance covers. Now, let us understand each and every cover, what it means and how it is applied, okay. Let us just clear this out. Let us talk about the whole life insurance cover, okay. A person is expected to live till 100 years. So, these are the covers which will ask them to invest that money, get insurance, and then probably at the age of 60, they will start getting some money back till they survive or till the age of 100, whichever happens earlier. Okay, that is called whole life cover. Endowment policies are of certain duration. So, what they do, so endowment policy will say that okay, there is a 30-year cover, this is the term, at the end of 30 years, you will get a maturity amount. Okay, so since you have paid me 30,000 rupees every year, maybe at the end of the cover, you may get some 50 lakhs or 15 lakhs or something like that. Okay, depending on the strategy of the policy. Money back policy. Money back policy tells that, okay, you start the cover, first 5 years are done, at the end of the 5th year, you will get some amount, at the end of the 10th year, you will get some more amount, at the end of 15th year, you will get some amount, and then maybe at the end of 30th year, you will get remaining amount. This is called money back policy. Children policy. This policy is specifically done for children education or marriage. So, when child becomes 18 years of age, probably this particular policy will mature and it will be given, that money will be given to the parents or the child to fulfill the financial goal. Annuity is very similar to the whole life policies. Now, unique link insurance policy is slightly different than the rest in the effect that unit link insurance policy will invest money in equity market. Okay. Rest of these policies will not invest your money in equity. Right. So, ULIP, as it is called, unit linked insurance policy, that is the only policy which will invest into equity. Now, the question is which one to choose. Obviously, you will feel that if these policies, except for the term life insurance policies, if all other policies are also having the investment component, and at the end of it, at maturity, I am going to get a big amount, rather I follow those policies than going for term insurance policies. But there is something you have to remember. What is the core principle of insurance? The core principle of insurance is to protect your life. So, the sum assured should be the guiding factor and not the return at the time of maturity. All these from whole life policy till ULIP, the premium value will be very high for the same sum assured as compared to the term life insurance, because of the fact that term life insurance is pure insurance, whereas the rest of the policies are having insurance plus investment in the picture. And so, I will just give you some very simple comparison. If my sum assured, that means I want a cover of 1.5 crores for a 30-year-old person, if I take a term insurance, okay, my premium may be around say 30,000 rupees per annum. But the same if I go for an endowment policy, which is going to give me money at the end of 30 years, okay, for the same sum assured, they may charge me 1.5 lakhs. Because now they have to segregate this into 30,000, which is towards insurance, and the remaining towards investments. Okay. So, one has to decide which type of policy he has to go for, right. So, this is what is about the life insurance policies. Let us now move ahead and talk about non-life insurance policies. For us, the most important and the one we know are motor insurance. So, whenever you buy a car, you have to take car insurance. Without that, you cannot get the car on the road. It is mandatory by law that you are covering the insurance, okay, of a third party insurance. That means, suppose your car hits a person, the cost of that person's expenses has to be insured, right. So, that is a mandatory thing. Travel insurance is also advisable, because if you are traveling abroad and you lose your bag or you fall sick, okay, in such occasions it is better that you have a travel insurance done properly. Workman's compensation, overseas medical insurance, fire insurance. Now, marine insurance is the oldest of all. This is the place where it all started. The concept of insurance actually started because of the marine insurance. At the end of this session, let us take a case study which is quite close to this marine insurance. Okay. There is a slight difference between the life insurance and non-life insurance. Obviously, there is no loss of life here, and that is why it is called non-life insurance. Okay. Personal accident cover. You will say that this is related to the human beings, so isn't it covered? Now, if the death happens because of the accident, that will be covered by the life insurance. But suppose the person survives, okay, but he is disabled, then personal accident cover has categories of how that person will be compensated. So, the disability will be judged at whether it is a permanent disability, whether it is a temporary disability, okay, and whether it is a partial disability or is it a total disability. Okay. So, depending on that, the insurance company will give some compensation to the person. So, for example, I am telling you, suppose a person is driving a bike and he meets with an accident and his leg is fractured, okay, and greatly fractured. It has to be operated for the 2-3 times, and as a result, he has got into a temporary partial disability, and doctor has advised him that the next 4 months that person will have to take bed rest. Okay. In that case, the company may say that, okay, since you have the accident cover, every week we will pay you X amount for the next, say, 100 weeks or 50 weeks, whatever is the case. Okay. So, this is how the personal accident cover works. So, it is not for covering the death of the person, but if the person meets with an accident and he gets into partial or total disability or temporary or permanent disability, then there is a kind of cover which is given to the person depending on the sum assured he has taken. Okay. So, that is the meaning of personal accident cover. So, these are the non-life insurance. Now, most of the places, companies which are giving life insurances are different than companies who are giving non-life insurances. Okay. They are totally different. All the insurance companies in India are regulated by an organization, by a regulator called IRDAI, Insurance Regulatory and Development Regulator of India. Okay. So, they are the ones who are actually governing all these companies, insurance companies. Now, another very important insurance, health insurance and critical illness cover. Whenever a person gets sick to the effect that that person has to get hospitalized, okay, minimum 24 hours of hospitalization is required for the person in that case health insurance will come in the picture. Okay. Health insurance will have sum insured, which is slightly different than we used to call, remember in life insurance we called it sum assured. Here it is sum insured. Now what is the meaning and difference of the two? If someone has taken 15 lakhs of health insurance, it's not that the moment he falls sick and he is hospitalized, the entire 15 lakhs will be given to him. Up to, what is the meaning of sum insured? The person is liable to get up to 15 lakhs of rupees, depending on the claim he has made, okay, which was different in the life insurance case. It is sum assured, means whenever that instance happens, the entire amount is given to the family. It is not up to. So, here sum insured. Now, what all happens here? Health insurance can be of two types. One is the person takes individual cover. Okay. So, there is a family, mother, father and child 1, child 2. Okay. The health insurance can be taken individually for all the 4 people, which is called individual life health insurance. Alternatively, they may say that since we are a family, let us take a floater. What is the meaning of floater? As a family, they take health insurance of 15 lakhs. So, anything happens to any one of them, they are covered for 15 lakhs as a family. Okay. So, most often people take floaters instead of individual when it is a family case. Different types of health insurances are available today. It is important and necessary that one finds out how much sum insured is required depending on the health condition of individual members of the family history. Okay. It is necessary that you find out how is there any ailment which is running in the family. Like there are some families, you know, they have diabetes history, some has say heart disease history. In such cases, it is necessary for them to take the proper health cover. Now, those whose parents are working for some corporate, they must be knowing that their companies are also covering the entire family for the health insurance. So, the normal question which is asked, if I have company cover, do I have to take health cover separately, privately? If that is the case, the answer is yes. Okay. Health cover should be taken as early as possible in life. Guys, remember I spoke about impact and frequency. And there was one category which was high impact and high frequency, and one of the example we saw was a diabetic person. Okay. A diabetic person will fall in high impact, high frequency case for health insurance, and insurance company will not give him the insurance. And as you age, because of our lifestyle, there are likely to get such problems in our life as diabetes. Okay. So, if one waits that I have my company cover and I will retire at the age of 60 and then I will buy my private health insurance cover, it might be too late. So, it is better that when the person is absolutely healthy, that person should get into a health insurance of his own, because that time he is into high impact but low frequency zone, and insurance company will be more than happy to give him the cover. Okay. So, that is very important, we have to remember this. Now, let us come to critical illness. What is critical illness cover? Because of our lifestyle, there are many diseases which are occurring all over the place, okay, and they are normally terminal or fatal. There may be instances where no hospitalization is done for these at all, okay. In that case, health insurance will not be useful. Then critical illness cover is useful in this case. Normally this cover will list all the different ailments which will get covered as or classified as critical illness. Okay, there can be heart related, there can be kidney related. Okay, if those conditions happen and they are medically proven, clinically or otherwise after doing sonography and blood test and everything, and the person survives for 30 days, then that lump sum amount is given to the family to take care of the person. Okay, that is called critical illness cover. Earlier people were not taking it, but now it has become a very common thing to have a critical illness cover. So that is about the health insurance and the critical illness cover. Let us understand certain terms. We have already used these terms in earlier slides, but now let us just go through different terms which are normally used in the area of insurance products. The first and foremost is sum assured or insured. We have spoken about it. It is the amount which will be given to the family if something happens to the person who is insured. Policy term, in our example we have seen the person was 30-year-old and he is going to retire at the age of 60. So, he wanted to cover himself for 30 years. So, his policy term will be 30 years. Premium. So, for the next 30 years, he is going to pay some money to the insurance company, correct, and that is called premium. Maturity benefit. So, let us assume that that person has taken endowment policy, okay, you remember endowment policy. So, what that person has done? He has endowment policy, he has a sum assured of say 50 lakhs, the policy term 30 years, he is paying premium per annum of say 50,000 rupees. Okay. After the end of 30 years, that person survives. In that case, the company has told him that I will give you 60 lakhs of rupees. So, that will be his maturity benefit. Okay. Claim. Unfortunately, the person dies at the age of, so currently his age is 30 years. Okay. At the age of 40 years, he dies. Now, the family will write to the insurance company of the unfortunate event that has happened and they will put up a claim. So, what is a claim? Claim is something which is actually raised by the person who has insured or by himself or by his family. So, if in life insurance it will be done by his family, and if it is a health insurance, once that person recovers, he himself can claim for the money. We will come to surrender value later. Let us talk about the death benefit first. Now, in this case the family has done the claim and the company agrees to the claim and 50 lakhs of sum assured is given to the family. Okay. That is the death claim, correct, death benefit, that is a death benefit. To whom money will go? The money will go to the nomination, because when he has taken the policy, he has told the nomination that okay, if something happens to me, 50 lakhs should go to my wife or to my child. Okay. So, that is nomination. So, these are the most important aspect of a policy. Now let us see the other things. Surrender value. Okay. So now this person has continued with the policy. After 10 years, he feels that this policy is not giving me good returns. I want to stop this policy. I am not interested in the policy. He can write back to the company saying that I am not interested in the policy anymore. I want to surrender it. In that case, company will give him whatever benefits he has accumulated till then. That is called surrender value. Lapsed policy. To keep the policy in force, the person has to keep paying the premium every year, or whatever is the frequency. Premiums can be paid every year, every month, quarterly, half yearly. One can choose and one can pay. But whatever is the frequency, that person has to abide by it. So suppose it is an annual premium and that person forgets to pay the premium. So there will be some time for which the policy will be in force, but after that the policy will get dormant, okay, which is called lapsed policy. Then reinstatement has to be done. That means he has to pay the money and get the policy reinstated, renew. Vesting age. If one person has taken a whole life policy, that at the age of 60 or something, he will start getting the pension. Okay, this is called vesting age at which he will start reaping the benefits. He will start getting the money back. Assignment. Now this is very important concept. Assignment is something like this. Suppose I have taken 10 lakhs loan from somewhere and currently I don't have the money to pay him, or that person is afraid that something happens to me, what will happen to his money. So I might take a sum assured 10 lakhs of policy and assign it to that person's name. So something happens to me, 10 lakhs will be given to that person, not to my nominee. That is called assignment. Beneficiary, the one who is actually get the benefit out of a trust, is called beneficiary. Exclusions, remember I spoke about this earlier also, exclusions, which is very important in the health insurance mainly, okay, because in the policy exclusions are written, these conditions will never get fulfilled or accepted for the claim, that is called exclusions. Insurable interest, now this is very interesting. People ask who should take insurance. This definition will tell who should take insurance. Remember what is insurance? It is a risk transfer. What risk? Financial risk, okay, which is created because the breadwinner is no more. Now what if a person is not earning anything and has no financial impact on the family? Should he take the insurance? There is no need. So who is the insurable interest? The one who has financial impact on the family can take the insurance, okay. And what is moral hazard? Moral hazard is nothing but I have taken the insurance and now I am getting into adventure sports, or there is a suicide attempt, okay, this is moral hazard. In such cases, insurance will not be liable to pay any money, okay. So these are some of the important terms which are there in insurance. What you should think while buying insurance? Remember, insurance is a long term commitment. So you have seen term policy, the policy term will be like 30 years, 40 years, it can be whole life policy. That means the company should be sustained for so long, right? Though they are actually controlled and monitored by IRDA, you have to also select good registered insurance companies, okay. They should be registered with IRDA. They should be under the gamut of IRDA. So first thing you have to do is see whether that insurance company is registered. Verify the genuineness, very important, because you are going to make premium payment, okay. There are some policies which are say single premium. So a big lump sum amount is given to the company and then company start giving you some money as a part of pension. Such cases are all the more you must verify whether the company is genuine. Choose the insurance which is suitable for your needs. Don't choose the insurance because some insurance agent is telling you. You verify what is the sum assured you want. Okay, for example, in health insurance cases, you must find out which are the types of hospitals you might get admitted to, what is the type of room you may get admitted to, private room or general category of room, right? Whether you want a cashless service, that means you get admitted, you don't have to spend anything, the company will take care of the cost, or you are okay with the reimbursement of the expenses, that means all the cost is borne by you and later on you claim to the insurance company and they will pay you the money. So, you have to be clear about that. Precautions: fictitious offers made by spurious callers, which is very common. You must be getting so many calls saying that we have an insurance company and things like that. Again, you have to remember, you have to go only for the registered insurance companies. Calls made in the name of IRDAI, which is very dangerous. No one from IRDAI will call you to tell you that you should take an insurance. You should file an FIR with police and intimate IRDAI if one is continuously harassing you for the insurance policies like that. Now, let us do one exercise. Okay. How do I calculate sum assured? Because the most important thing here is how to find out what is sum assured. Okay. Two examples I will give you. One is about how to find out sum assured for life insurance, and then we will talk about something different which is called how the insurance was born. Okay. So, how actually the marine insurance came in the picture, so that you get idea about the non-life insurance as well. Life insurance, one is on the thumb rule, 20 times your annual income. Okay. So, if your annual income is 5 lakhs of rupees, 20 times is 1 crore. So, that person should have at least 1 crore of sum assured. This is a thumb rule. If you want to get into more details, then 3 components you have to remember when you have life insurance sum assured. One, if you have any outstanding liabilities. Second, are there any dependent expenses? Which you need to take care of. And third, day-to-day expenses of the family. Example, if one person is, there is a family, okay, the person is say 35-year-old, the father, okay, his wife is say 32-year-old, the child is 3-year-old, okay. They have taken a house and there is an outstanding amount of 80 lakhs is an outstanding liability. So, how do you calculate his sum assured? First is this 80 lakhs, because that has to get repaid. Dependent expenses, his child is dependent for his education and marriage. Okay. So, he wants to keep around 50 lakhs for him. So, his primary education, his secondary education, his graduation, post studies and his marriage, everything is taken care by that. For the day-to-day expenses for the family, he wants to keep say another 2 crores. Now, there are proper ways of calculating all this, but we are just taking a ballpoint figure. So, total sum assured for him will be around 3.3 crores. Okay, depending on his life situation. So, this is how the life insurance sum assured has to be calculated properly. Okay. Now, let us come to how this particular insurance concept was developed. So, way back when people used to travel, they used to travel by ships. Okay. So, the main way of transportation of people and cargo used to be by ships. And let us assume a case when there was a village and the village has 5,000 families. Okay. On an average, every family breadwinner is earning 60,000 rupees per annum. Okay. It happens that once in a year, at least one person dies while he is on ship. Okay, one person dies. Now, what happens when the person dies? His family stop getting the 60,000 rupees year after year. And so, the leader of the village, he wonders like, how can I help these people? So, he tells everyone that let us contribute 250 rupees per family every year. So, 250 into 5,000. So, around 12.5 lakhs are accumulated every year. Whoever person deceases, his family will get 12 lakhs of rupees. Why 12 lakhs? 60,000 he used to earn every year. For next 20 years that family is taken care of till the children are grown up and they can start something. Okay. Now the families are not troubled because they know if something happens to the breadwinner, we have a backing of the entire village and we are going to get this 12 lakhs. So, from here the life insurance started. Okay. It also went to the cargo insurance because ships used to get damaged, right, and people used to face problems in expenses repairing them. So, slowly along with this the ship repairing insurance started. When they used to face storms, they used to lose their material in the cargo in the ship. So, for that the insurance started, and this is how the insurance actually started and it started taking place. So, that is the concept of insurance we have seen. Let us see what all we have actually seen here. So, insurance is given only against pure risk. Okay. It is not given for any financial risk, it is given only to the pure risk. And what is pure risk? Where the instance gives only losses, there is no possibility of gain in those instances, they are called pure risks. Understanding the difference between the pure and the financial risk there can be gain or loss, pure risk only loss. Risk treatment has to be decided depending on the impact and the frequency. So, these are some of the tactics. The only type of risk which is accommodated is risk transfer, is high impact and low frequency. Rest of the risks have to be borne by the individual. Different types of insurances we have seen: life insurance, non-life insurance and the health insurance. We have seen how to ensure that we have the adequacy of the sum assured. We have seen either there is a thumb rule or there is a human life value calculation taking into consideration the outstanding liability, the dependent expenses and the day-to-day expenses, and how you should be careful. You should buy your insurance products from a IRDAI regulated companies. So, that is all about insurance products. Thank you.